Hey everyone, and welcome back to the channel. Today we're diving into a topic that affects almost all of us: taxes. I know, just hearing the word can make you want to click away, but stick with me. What if I told you there are completely legal ways to lower your tax bill and keep more of your hard-earned money? It's not about secret loopholes or shady schemes. It's about smart, legal tax planning. So grab a notepad, because by the end of this video, you'll have a much clearer picture of how to make the tax code work for you, not against you. Let's start with the basics. What exactly is tax planning? Think of it as a roadmap for your finances. It's about understanding the tax laws and structuring your financial decisions in a way that minimizes your tax liability, all within the legal framework. It's the difference between letting your finances happen to you and taking control of your financial destiny. So, where do we begin? The absolute foundation of good tax planning is maximizing your retirement contributions. This is a strategy that benefits almost everyone, whether you're an employee or self-employed. Let's talk about traditional retirement accounts like a 401k or a traditional IRA. When you contribute to these accounts, the money you put in is often tax deductible. This means it reduces your taxable income for the year. For example, if you make $70,000 and contribute $5,000 to your traditional 401k, the IRS only sees $65,000 of income. Right away, you've lowered your tax bill for the current year. Plus, that money grows tax-deferred, meaning you don't pay any taxes on the investment gains until you withdraw it in retirement. Many employers even offer a matching contribution for your 401k. That's literally free money. Not taking advantage of a company match is like turning down a pay raise. So, rule number 1. If you have access to a workplace retirement plan, especially one with a match, contribute as much as you can, at least up to the full match. Now, what if you're self-employed or a freelancer? You have even more powerful options. Look into a SEP IRA or a solo 401k. These accounts allow you to contribute a much larger portion of your income compared to traditional IRAs, giving you a massive potential tax deduction. It's a fantastic way for business owners and side hustlers to supercharge their retirement savings and slash their current tax bill at the same time. The key takeaway here is that retirement accounts are one of the most powerful and accessible tax planning tools available to the average person. Don't leave this money on the table. Next up, let's talk about tax credits versus tax deductions. It's crucial to understand the difference because one is much more powerful than the other. A tax deduction, like the retirement contribution we just discussed, lowers your taxable income. A tax credit, on the other hand, is a dollar-for-dollar reduction of your actual tax bill. Think about it this way: a $1,000 deduction might save you $220 if you re-in the 22% tax bracket. But a $1,000 tax credit saves you the full $1,000. It's a direct discount on the taxes you owe. So, what kind of credits should you be looking for? There are many. The child tax credit is a big one for families. There are education credits like the American Opportunity Tax credit and the Lifetime Learning Credit if you're repaying for higher education for yourself, a spouse, or a dependent. There are also credits for making your home more energy efficient, like installing solar panels or new windows. The government literally wants to reward you for these things. The list of available credits changes, so it's important to stay informed each year. A quick search on the IRS website for tax credits will show you what might be available for your specific situation. Don't assume you don't qualify. Always check. Let's shift gears and talk about something called tax loss harvesting. This sounds complicated, but the concept is pretty simple. If you have a non-retirement investment account, like a standard brokerage account, you can use your investment losses to offset your gains. Here's how it works. Say you sold some stock this year and made a $5,000 profit. That profit is a capital gain, and you'll owe taxes on it. But maybe you have another investment in your portfolio that's currently down by $3,000. You could sell that losing investment, harvest the loss, and use that $3,000 loss to offset your $5,000 gain. Another area that's often overlooked is health savings accounts, or HSAs. If you have a high-deductible health plan, you might be eligible to contribute to an HSA. And let me tell you, HSAs are a tax planning superstar. They offer a triple tax advantage. First, your contributions are tax-deductible, lowering your taxable income for the year. Second, the money in the account grows tax-free. And third, when you withdraw the money for qualified medical expenses, those withdrawals are also completely tax-free. There is no other account in the U.S. tax code that offers this triple benefit. You can use the funds for everything from doctor visits and prescriptions to dental and vision care. And here's the best part. After age 65, you can withdraw money from your HSA for any reason, not just medical expenses. It will be taxed as regular income, just like a traditional IRA, but it remains tax-free for medical costs. Many people use their HSA as a supplemental retirement account because of its incredible flexibility and tax advantages. If you're eligible for an HSA, it's an opportunity you absolutely should not miss. For those of you who are charitably inclined, there are smart ways to give back that also benefit your tax situation. Of course, you can deduct cash donations if you itemize your deductions. But have you considered donating appreciated assets, like stocks? Let's say you bought a stock for $1,000 and it's now worth $5,000. If you sold it, you'd have to pay capital gains tax on the $4,000 profit. But if you donate the stock directly to a qualified charity, you generally get to deduct the full fair market value, the $5,000, and you don't have to pay any capital gains tax. The charity gets a larger donation and you get a larger tax deduction. It's a win-win. This strategy, known as donating appreciated securities, can be a much more tax-efficient way to support the causes you care about. Now, let's talk about a choice many taxpayers face, taking the standard deduction versus itemizing it. The standard deduction is a fixed dollar amount that you can subtract from your income. For many people, it's the simplest and best option. However, if your individual deductible expenses add up to more than the standard deduction amount, you should itemize. What can you itemize? Things like state and local taxes up to a certain limit, mortgage interest, charitable donations, and significant medical expenses. The key is to run the numbers both ways. Don't just assume the standard deduction is better for you. Every year, add up your potential itemized deductions. If the total is higher than the standard deduction for your filing status, then itemizing will save you money. It takes a little extra work, but it can be well worth the effort. Finally, a word about life events. Getting married, having a baby, buying a home, or starting a business all have major tax implications. These events can change your filing status, make you eligible for new credits, and open up new deduction opportunities. The mistake many people make is waiting until tax time to think about these changes. The best approach is to adjust your tax strategy as soon as these events happen. For example, when you get married, you should revisit your W-4 withholdings with your employer to make sure the right amount of tax is being taken out of your combined paychecks. When you buy a house, you can start deducting mortgage interest and property taxes. The point is, your life isn't static, and neither is your tax situation. Staying on top of these changes throughout the year is the essence of effective tax planning. I know we've covered a lot of ground today, from retirement accounts and tax credits to investment strategies and The main takeaway is this: tax planning isn't just for the ultra-wealthy. It's for anyone who wants to be more intentional with their money. By understanding these legal strategies, you can take control, reduce your tax burden, and accelerate your journey toward your financial goals. Remember, this information is for educational purposes. And it's always a great idea to consult with a qualified tax professional or financial advisor who can give you personalized advice for your unique situation. They can help you navigate the complexities and ensure you remaking the best decisions for your financial health. Thanks so much for watching. I hope you found this breakdown helpful and a little less intimidating. If you did, please give this video a thumbs up and consider subscribing for more content on how to manage your money wisely. Let me know in the comments which of these strategies you're going to look into. I'd love to hear from you. Until next time, take care and plan smart.